Good morning. Good morning. Good morning. Welcome to our Dealmaker calls. I see we've got Dan on this morning. Good morning, Dan. Good morning, Nathan. Scott Brown, it's been too long, sir. We need to spend some time together. Sari, Glenn, good old Glenn. He's been a couple to our events. He's a good guy. Eva and Nick are on already. Tim, Robert, hello, hello. Welcome, welcome. I think we're going to have some of the smartest investors on today. So just want to kind of let you guys know that. Um, I'm really excited about today's topic. Um, anybody have a quick story from the last week or anything anybody wants to share before we get going? Before people pop on here, people are going to still probably pop on the next couple minutes. What do you got going on, Scott? What are you working on, Scott?
I'm just basically doing the flip your capital model, partnering with flippers.
I gotcha.
So
Well, good, good,
um,
good.
I am seeing a little slowdown though.
Oh, we've seen that. I think we've seen a slowdown for the last 2 years, and people really haven't seen it in certain markets, but it's definitely there. I have a feeling we're in for a rough winter. I was telling my team, I think we're at the point in the market where we're going to start actually seeing the really bad. Everything's going to start to unravel. And then in 2026, what does the US government do every single time? Well, they create stimulus, and we'll probably see another big stimulus package in 2026 to kick the can down the road a little farther. And it's funny because if you read Farmer's Almanac, this is a thing. Read the Farmer's Almanac when it comes to investing. There's a whole thing out there, and it actually says 2026 is going to be a good year to sell anything. So keep that in mind. Then it's supposed to be for 4 years. It's supposed to be a bad, possibly bad for 4 years. So, anyways, I'm excited about today's call. I'm going to get it kicked off for us all. Appreciate everybody being on this morning. Just a little bit about me before we get going. I appreciate all of the thoughts and prayers over the last couple of weeks with the passing of a good friend of mine, my accountant as well. I was actually also telling my team, Vern, that I've met you over the last uh, 3 or 4 months. Like 3 times we have bumped into each other and been able to see each other. And I just had this feeling every time that I was seeing you, Vern, that there was a reason. I mean, like this guy's been put in my life for some reason. And I just kept thinking in the back of my head, I don't know what it is yet. And then with the passing of Josh, I'm like, okay, maybe God was preparing me for this. And it is possible, Vern, that you are kind of like a godsend to me in my life. And again, I don't know you super well, but I know a lot of people who know you and speak very, very highly of you. So I'm excited to have you on today. You said that you still do tax returns. I may be calling you for that. I haven't figured out exactly where I'm going to go with that. I don't need bookkeeping help. But I need somebody who understands the complexities of 11 different businesses and different types of balance sheets and how they all work together. And I think somebody that has an engineering background like Vern would be maybe the perfect person that I can, go over that with. And it might actually excite Vern to kind of get in there and figure out, not he's weird, folks. I'm just going to let you know he's a little bit weird, but it's weird in a good way. And we're all weird a little bit. It's not a contest, right, folks? So I'm excited to have Vern on. We're going to talk today about cost segregation and a little bit. I think we're going to tie this into our next call a little bit with opportunity zones. And in my opinion, this may be one of the biggest tax advantages that is in front of us today. And I don't think enough of people in our community are taking advantage of this. So I'm excited about this. I hope you guys are as well. If you guys didn't get on last month's call, we had Gary Harper, a good friend of mine, with Sharper. Interesting story. I used to own 10% of Sharper. I helped him start that business. We used to be partners. He used to actually be a partner in good success with us as well. So it was a good call. If you guys haven't watched that call, you guys can always go back and watch those calls as well. Vern, this call it will be on This will be also on there, and probably by the end of the week, this will be for you guys to be able to watch over again. Because I know, as it is with, if it is with the same with you guys, it is with me. I always find myself like watching something, and I'm like, I need to go back and listen to what he said again. And I think for these next couple topics that we're going to have, that's definitely going to be the case. So there's the way to be able to go back and watch those over and over again, if you guys are interested in that. Want to remind everybody in the Dealmaker community, if you're not already signed up with our Lowe's discount program, in order to get the biggest Lowe's discount, you've got to be a Lowe's Pros. You've got to put all your credit cards in there, and then you have to order online. I cannot tell you guys, cannot stress to you guys the importance of ordering online. And it might sound like, oh my goodness, this is a this is a hardware store. Like I go to the hardware store. Guys, stop going to the hardware store. It will save you time. Just like your wife has already realized that Instacart is much better than going to Target and having the stuff delivered to you, you will find out in your own business. So for our Lowe's program, guys, the entire store ships for $20. So if you order like a piece of wood or if you order a whole house, the entire order ships for $20 with our program. I promise you, it's not worth your time to go pick up that stuff. It's not worth your time of your teams to send them to Lowe's or Home Depot or wherever you're going. So get involved in that. And then also the Sherwin-Williams discounts, guys, is the best discounts. It's better than National Home Builders discounts. And if you don't believe me, just try me and you'll see. So get signed up for all those discounts. You guys can take a picture of this if you're not already signed up with the Dealmaker, Sherwin-Williams, and get that taken care of. And you guys can take a picture of this. I'm not going to spend any more time on that. If you guys are interested in giving to a good cause, we are raising money for our seniors to go to the Dominican Republic next year. And so far, we've raised about $12,000. We still need to raise about $18,000 more for that. So I'm excited about that. Do this every year. I think it's important for kids to see how the rest of the world lives, and to go out and be a givers. But they also get to have a trip of a lifetime as well as their senior trip. They get to do some fun stuff. So if you're interested in something like that, please let me know. You can get the QR code right there and give directly. You can bypass me completely. It goes right. It is a 501(c)(3), so you will get a tax deduction for that. Upcoming, we've got some things upcoming. Sunrisers is every Friday. I actually think this Friday she's not having a sunriser, so I take that back. It's almost every Friday. But Wendy, who was one of the speakers here at our Dealmaker Gary a couple weeks ago, she runs that, does a really good job of that. We have prayer, devotion, talk about real estate every Friday. It's a good meeting. I highly recommend it. In a couple weeks, we will be with Jim Ingersoll in Dallas, October 22nd, 23rd, and 24th. And we will be talking about private lending, private borrowing, private lending, all the things that you need to know. There's a ton of stuff that's going into the background of this. I am actually excited to be able to do a fun mastermind. So it's going to be a fun mastermind. It's not going to be a hot seat mastermind. We are going to have some fun with it, and I'm excited to be able to be there with all you guys. I hope you guys are coming. If you haven't gotten your tickets, I know I talked to Jim this week, and he said he's only got about 10 tickets left, so I hope you guys will take advantage of that. We still have early bird pricing for next year's Gary Dealmaker, October 1st through the 3rd. I know it's a long ways out there, guys, but those early bird pricing tickets will go up at some point, so make sure you guys get those. Next month, I don't know I know Vern talked to Ashley this morning about possibly popping on today as well. I'm not sure if he's going to pop onto this call with us or not. But I am planning on joining Ashley's group myself. I met him at the last John Hire event. And I believe Vern is actually a part of this group as well with Ashley, and he is the opportunity zone guy. He is the guy in the whole United States. And it's really interesting when somebody like John Hire says, I used to think I knew a lot about opportunity zones until I met Ashley. And I'm like, okay, wait a minute. For John to say something like that, I'm like, I gotta learn about a little bit about who this guy is and what's going on here. So he has something he'll talk about for opportunity zones as well. But I'm excited to do this for myself. And I'm excited about using Vern's system and using Vern on the cost segregation. I don't want to give away too much of what Vern's going to talk about, but I'm just going to tell you guys, I'm excited about this myself. I think it's a big part of what our businesses are going to start pushing towards and our understanding and our knowledge in this space. Think about this, guys. If even if you don't have 1031 money, and just think about if you're a flipper or if you're, somebody in your market, if you understand opportunity zones, there are other ways to make money know having that knowledge as well. I'm gonna tell you that if you can say, hey, this property is in an opportunity zone, you're gonna open up a whole new world of buyers for that type of deal that you wouldn't have had. So knowing the opportunity zones, where they're at, I think can help in many different areas, not just having an opportunity zone yourself as well. So that's all I'm going to say about that. I'm going to get on to Vern. I'm excited to have Vern. I'm going to let Vern tell you a little bit more about himself. I have learned that he is an engine. He was an engineer. I'm always excited to hear people that started what they're doing because they had a big problem. And I hope Vern's going to tell you about the problem that he had before he started learning about cost segregation. And he has an engineering background, so I'm excited to have Vern on. We're going to stop sharing, and I'm going to share the floor with Vern. So thank you, Vern, for being on. I'm excited to have you on. I know there's some really smart people on here. I'm going to let you have the floor, and you got it, buddy. So you can go till honestly, normally the top of the hour is about the time we end, but I do let people stick around if there's questions and stuff. So sometimes this goes till 11:15, and we've even had to go to 11:30 if there's that many questions and that much interest. But appreciate you being on, Vern, and I'm just gonna give the floor to you, sir.
Well, thank you very much for that glowing introduction. So, I am an engineer. I worked for Jeep Corporation, and we were bought and sold, I think, 5 times while I was there, and got used to being on the go-to team to make sure we could keep Jeeps rolling down the line. Um, Graduated from University of Michigan with a bachelor's and a master's, and I'm also a licensed building contractor because one of the building inspectors pissed me off on one of my houses, so I decided to go get a builder's license so he couldn't call me out anymore. And kind of leads me to my story about how I got into cost segregation and taxes, is because part of that, one of those moves, while I was at Jeep, we got bought by Chrysler, and I had stock options at the time, and they were 4 years into the 5 year vesting program, so I was very close to making $200,000. And what happened is, according to the IRS code, they had to reprice those options, and when they did, I didn't get American Motors options. I got Chrysler options, and they vested out 5 years down the road, not 1 year. And so that really put me at a quandary. But then I got a notice from the IRS 6 months later. It said, oh, that $200,000 that you didn't get, that's called phantom gain, and you get to pay tax on $200,000, which I didn't get, which kind of pissed me off because that was 3 times my normal salary back then. That was in '86. And that made me go down the rabbit hole of taxes and what else I could do to eliminate taxes. I didn't find a lot, except I found out about phantom losses, and that's what led me to cost segregation and bonus depreciation. So that's really why I am here today, because of what happened almost 40 years ago led me to establish 2 businesses, one in taxes and one in cost segregation. Has led me to where I am today. So with that, I will get started. Tom, if you can just tell me, can everybody see my slides right now? I want to make sure I'm going on with the right.
No, and they apparently they couldn't see all mine either, so I'm not sure. Make sure you share your screen there at the beginning, at the
Well,
bottom.
I'm going to shut it off then and share again. That's why I wanted to ask. Okay, so I'm going to share. Here we go. All right, now can you see a screen?
Yes.
All right, now let me bring up the slideshow right there. Too many things on here. All right, well, I don't know how to switch that one, Tom. It looks like
Well, yeah, just press slideshow
I did that.
and then go to the left and play from start.
Okay, got it. I missed that one step. Okay, technology isn't my forte, guys. All right, I'm Vern Schmidt. Engineered Cost Seg Solution is my rollover business startup that I run all of my cost segs through. Um, What I'm going to talk about today is a cost segregation explanation because a lot of people have no idea what it is. I'll also talk about short-term and real estate professional status because that allows you to access all the losses that you can gain, all the phantom losses you can gain from cost seg studies. I'll talk a little bit about what a good cost segregation study looks like. I'll also talk about do-it-yourself versus engineered cost segregation comparisons because there's a lot of difference out there. You'd be surprised at what you give up by trying to do it yourself. And finally, I'm going to wrap up with an example of an opportunity zone I'm a part of in Indianapolis where we're building 5,000 square foot duplexes. Typically, there's 4-bed, 5-bath on 3 levels, and it's rented mostly to interns that are doing their follow-ups on getting their medical license at the 4 universities that are in the greater Indianapolis area. So with that, I'm just going to get started. What is cost segregation? It's really just a way to bring all the future depreciation pretty much into the early years of the tax schedule. It can be useful to you if you've got high taxes in some years, you want to not pay as much in tax. There's a way to do that. It does come at a cost, though. You've got to decide if it makes sense to pay $2,000 to $6,000 to bring some of that savings ahead to use now. And it's really all about the time value of money. If you can do it, great. If not, you just let it run over the 27 years and work your way out that way. That's perfectly acceptable. Now, cost segregation really involves breaking down your property, whether it's a commercial building or a single family home, into 3 asset classes. Personal property, which you depreciate over 5 years, land improvements, which you depreciate over 15 years, and buildings, which are 27.5 years. Most of you are familiar with the last 2 here, building and land, which you don't get any depreciation on. And most accountants typically do an 80-20 on whatever building you get. They will give the building 80% and the land 20%. I'm going to show you why that's not necessarily the case, backed by Supreme Court examples where they've ruled against that type of evaluation. So this chart does nothing but show you what you can do with bonus depreciation and cost segregation. The blue line indicates what just passed in 2025, anything after January 19th of 2025. You can pull all of the, what I would say, these little orange bars here. That would be the 5-year personal property. This would be the 15-year land improvements. They go away after 15 years, and then all you're left with is a building improvement, the building itself. What normally happens is you're on this little blue line here all the time, okay? So all cost segregation does is it allows you a way to pull all that forward so that in year 1, you get, in this case, it's a $600,000 property, get almost $180,000 just for that year. So it's just timing. You bring it forward if you can use it. If not, you don't let it run its course.
So can you explain the 180,000 on that last slide? Is 180,000 that's loss. So it's basically it's not tax credit at this point. It's basically a loss against your other income.
Yeah, this is depreciation, which will go as a net operating loss. If you have more, it will go against your W-2 income if you qualify. If not, it just carries forward. But what you don't want to do is try and take this and find out your passive loss limited, which I'll talk about. Because if you make more than $100,000, you can only take 25,000 of losses. So it wouldn't do you any good to get 200,000 if you can only use 125 of it, and the rest goes into a black hole because it's a suspended loss. You can't use it until you sell the property.
Right. Okay.
All right. Okay. So this is what personal property is. Many of you don't understand. There's a lot more than just appliances in there. Hot water heaters count. Window air conditioners count. Not the outside units, but window air conditioners. Any furniture, like if you're doing short-term rentals, that's all can be written off. Blinds also qualify. Fire extinguishers, smoke detectors, sump pumps, and a lot of where most of the people get their losses is movable floor tile or carpeting is not glued down, and other removable floor coverings. And what's been going on the last 10 or 15 years is LVT or LVP, the laminated vinyl plank, which is very hardy in rental situations, but it's also removable, and that counts as a personal property. You can write all that off, including the installation. Land improvement items, anything that God didn't put there, pavements, sidewalks, curbs, driveways, concrete patios, decks, fences, swimming pools, all those can be written off over 15 years. And then what's left is typically the building. You guys all know what that is. That's what you're normally familiar with. And I put this slide together because it'll show you the average price of a property that I typically do cost segs on and what the range of depreciation is. And the reason there's a range is because every property is different. Some people have a lot of ceiling fans. They like those. Other people, they like hardwoods. They don't like the LVPs. Some people like to tile things, especially if you're in like the Florida market. Most of your floors are tile. They're not LVP. And this can affect your range. I've had some houses that I only get a 15% write-off. It's typically not good, but most of the ones I do are going up to 35%, which means you can have like a $70,000 swing on a $400,000 house. And this is what you could typically get between $80,000 and $150,000 depreciation loss that you could write off. So this just puts together what you could actually see. And I don't give tax savings because it really depends on what your effective tax rate and where you are with all the rest of your businesses that you're running. So you really have to look at this congruently with your accountant to make sure that you're doing the right thing. Now, what I'm going to just walk through is just a few slides on showing the difference in what a typical house would be. A standard $100,000 single family home. Typically, it's going to be $100,000 broken up by 80% building, 20% land, which you don't get any depreciation on. Your standard depreciation here is almost $3,000 a year for 27 and a half years. No, nothing new there. If you do a cost segregation, that same $100,000 house, the personal property would be $20,000, which gives you a $4,000 depreciation. Land improvements are 15, gives you 1,000. And then you've got what's left, the 45,000 is the actual building, which gives you another 1,600. And again, land is no depreciation. So you add those all up, and you get close to $9,000 or $10,000 that you can write off.
On a $100,000 property.
Right. Now, if you do the bonus depreciation, which came back, I mean, it was 100% from 17 to 23, and then it's been phasing down. It'll go down to I think 40% this year and 20% the next year. But this shows you what you can get. You pull all that personal property, the 20 and the 15 I had, that's 35,000 there, plus whatever's left, you get $36,000 with 100% bonus depreciation. You pulled it all forward into year one.
And that's with 100%.
That's with 100%, which is going forward from 2025 on.
Right, with the with the big beautiful bill.
I believe, people haven't been paying attention to that, but I believe it only runs for 4 years. Then it drops back to what the standard rates would be. So
I gotcha.
Most people have just been so excited about 100%, they forget that it does expire. Okay, I turned down 50% of the requests to do cost segregation studies, and multitude of reasons, and I'll just walk through them because this may apply to some of you, and it'll just excite you or you. It depends on where you are in your journey. The juice just isn't worth the squeeze. In other words, you don't get enough depreciation savings to start spending the money. I typically won't take one unless I save you at least twice what you pay for the study, because I'm not looking for more work. I've been retired now 3 times from businesses, so I do this for fun, guys. Too much income and no real estate professional status. And again, passive loss rules limit your write-off to $25,000 or less. And we'll go through that in some detail so you can see how that would impact you. Clients don't have the property on their tax return. I had a guy who wanted me to do like 15 cost segs, and when I went through it, his depreciation schedules were a mess because he didn't have the address on each property like you normally do. He just had house 1, house 2, house 3, apartment 1, apartment 2, apartment 3. And I could never tie the savings down to the property so I could enter it correctly. But then I found he had a $4 million apartment complex. That's really the straw that broke the camel's back because he didn't have it on his tax return. I said, guys, you can't do a cost seg study because I can't give you depreciation if you're not even claiming the income or any expenses. So um, that one surprised me. If you're going to be selling within 5 years, I don't recommend doing it because you just have to recapture it and you're really not going to save a lot then. Here's one that catches a lot of the mobile home park people. They think they're getting smart because they spell out the allocations for the home and the land. And once you spell that out, there's been Supreme Court cases where they state that if you have already specified how the breakup is, you can't go back and do a study. So you basically have shot yourself in the foot. Anything I could get you, you can't use. So it's really a waste of time and money. And then there's the PETA, pain in the ass. People that call me multiple times, talk 20 to 30 minutes, and they just keep delaying and delaying. They never pull the trigger. So yeah, Scott, I see you talking there. I typically will you're just going to get blocked from that point on because I do have to make some money to keep this thing going. But, some people just can't make happy. All right. Now, common mistakes I see. I have had at least 3 cost segs done, and the people came back to me and said, you were wrong. This cost seg didn't help me at all. And when I go back and look at their tax return, their accountant had never even put it on the tax form. It just left it off completely. They've since become my clients because at least I know how to do that. The other thing I find a lot of times is the accountants will put land value at 0. There is no land value reported on the depreciation schedule. So I always go back and make sure I have depreciation schedules so I can see what really is going on. In this case, the HUD price was the price they fully depreciated. It's like, guys, you got to go back and do a reverse 3115. You got to add income, not take income away, which typically doesn't make them very happy. Clients also think they can use the current value and not the basis. I'd love to do it at current value. That makes it so much better, but you got to go with what you paid for the property. Now, here's the next 2 are going to be very interesting. And this is nothing to do with cost segs, but it's something I've seen with 2 audits I've had. I've actually had 3 audits, and 2 of them were no difference found in the audit, so that was fine. But the guy insisted he'd go with me to meet the auditor. And I explained to him, if I bring the questions back to you, you at least won't incriminate yourself. But they thought they knew better. And the first question he asked was, do you accept cash? And the guy said, well, yeah, sometimes they pay me in cash. And it led to us very simple, well, where do you put that cash? Well, I put it in my personal account. And said, oh, and then you move it out to your LLCs? Oh, no, they don't have checking accounts. Like, oh, wait a minute. So now we're going to audit every one of your businesses. He had 5 or 6 companies. And that leads to number 5, the commingling of funds, which John Heyer talks about all the times. He didn't really have a real life story to go with it. I had one because this guy called me back. This happened in 2000 and I think 20. And he called me back this last summer and wanted to know if I would review his financial statements and give him advice on taxes. I said, why would you do that? I mean, you were just involved with an IRS audit. I said, oh, but I didn't know what I was doing then. I didn't take your advice, and I've seen the wisdom in your ways right now. And he told me that they originally were willing to settle for $500,000. But after 2.5 years of going back and forth and providing all kinds of audit backup, he finally got it down to $200,000, all from commingling his funds and not following the right procedures. So
Don't do it.
Don't do it. When does it make sense to do a cost seg study? When you got a change in passive income you need to offset? I typically do a 5-year look ahead, do a 5-year projection, what you think you're going to be making to see what your tax status would be, and typically what you would have to have in number of homes bought to eliminate your taxes down to 0. When you have a change in your real estate professional status, and typically you have to have 750 hours and more hours in real estate than in your W-2 job. If you qualify for that, and this can be a yearly designation, you're entitled to a full write-off. When you have a change in taxable income, it's usually higher and you need to offset. The people are getting less income. There's not much urgency to do anything. And this is one that most people don't realize. Before too much time has passed, because depreciation, you can do a Form 3115 change in accounting and bring all depreciation that you should have taken forward to this year. So if you haven't done any depreciation at all, you can bring it all forward to 2025 and use it. But typically, after 12 years is too long. It doesn't really give you much benefit because you're kind of over the hump on 5 and 15-year property phase outs. I like to think of a cost studies as tax reductions in reserve or banking losses until you need them, because you don't have to do this. If you're happy with where your income level is, you just keep it there. And if you get a big jump in your income one year, you can do a cost seg on one property. You don't have to do them all. And then here's one I haven't had much experience with, but technically it works on paper. If you sell a property and you're in a high tax bracket, like 37%, you can actually do a cost seg study after you've sold the property and move down to the 24% bracket and save 13% on the tax. I typically don't recommend it. I like you to plan ahead more than this. Here's where we get into passive loss limitations.
Yeah, I'm glad you're going to get into this because there was already a question in there about like Scott said, Vern, did I hear you correctly? You can only take $25,000 a year against your income above $100,000, so the net benefit would be like $6,000 to $7,000. Am I following this correctly?
That is following correctly. I'm good to see he's one of the top students in the class. But that's only half of it, because if it's once you go up to 150, they gradually reduce this to zero. So once you're over 150, you don't get any benefit from doing a cost seg study because you're limited. You don't even get passive loss limitations. So and these just go into abeyance. You use them when you can after that. But typically, if you're still making high income, you're never going to get to use those losses. This normally applies to anybody who's not a real estate professional.
And can you explain the difference? Because I think most people on this call are going to be real estate professionals.
Explain the difference between what?
Like, because you're saying that this applies to anyone who's not a real estate professional. So what if you are a real estate professional?
Then this doesn't apply. You've got a get out of jail free card. You can use all the losses you can generate.
That's what I thought. Okay. Yeah. Okay. Does that make sense, Scott? Yeah. So if you're a real estate professional, like I said, most people on this call probably are, Vern, because this is a real estate group. Then so basically you can use all of these losses as long as it's up to your income that you made that year. Obviously, you can't go past your income that you made that year. You would just sit and bucket forward.
Well, there's also another one that you can only offset your losses up to 80% of whatever your income is. So
Okay.
you got a W-2 making 100,000 and your AGI is 50, you can only go up to 80% of that 50,000 or whatever.
Okay.
Okay, and the other ones then, any losses in excess are carried forward or suspended until you have passive income or you sell the property. So then you have to find a passive income generator so that you're making money that you can afford to take the losses. The next one, did I miss the short term? No, it may pop up here in a minute. I must be going the wrong way. Yeah, here we go. Short-term rentals. Short-term rentals, which are all the rage these days, are an active business. They're like mini hotels. They are not real estate plays. Typically, what you find here is very high income earners making 400,000 or more has a non-working spouse handle the short-term rentals. And what they do is they buy a vacation rental. And it's important you have to keep the average rental period to 7 days or less. So your typical real estate plays are not going to work for this. You have to do enough material participation, and there's 7 different levels of participation you can do. I picked the main three rules that we focus on. You got to have 500 hours in day-to-day operations. That's material participation, or 100 plus hours and more time than anybody else if it's self-managed. So typically what happens, and then the last one is substantially more time than anybody else that purchased November, December. What these folks do is they typically buy a property in the August to September timeframe. They spend the 100 plus hours getting it fixed, getting all the furniture in, getting it the way they want it, and then they put it in service November, December, so they get at least 2 rentals. And this is actually, they've been some court cases on these where you have to have at least 2 rentals to qualify for the short-term activity. They call it a loophole, but it's really just, it's always been, I used this 25 years ago when I started with lake rentals, vacation rentals on Lake Erie for 3 months of the year and generate enough income on those 3 months to exceed what I was making if I'd rented it full time. So this has been around for quite a while. What this does, it changes from passive income or loss to active income or loss. So then it will offset against whatever income you've got. If you do a cost seg on this, generate 200,000 of losses, you can take it against your 200,000 of income. So that's what a lot of people are doing. And then if they don't want to work it, they turn it over to a management company and they buy another one and do 100 hours on that one. So it allows you to play the game. Now, this is what it takes to be a real estate professional. If you guys are all that, I don't have to tell you about this. You know all about that. So we won't spend any time there. Okay. I typically get a lot of engineers that think they know how to do these. And I just give them the cost segregation audit techniques guide, which is, if you printed it out from the IRS website, it's about 150 pages, including all the backup material that goes with it. But it tells you exactly what they're going to do when they audit a cost segregation study. And I've been doing these now for about 20 years now. It wasn't big until the bonus depreciation really kicked in. But I have not had a cost segregation study successfully challenged in all that time. And they usually, if you're following these procedures, they usually don't even go after them. What they usually do is they're looking for, do you have enough hours documented for real estate professional status? And they will ask for your calendar. If you've got it and you turn it over within 3 to 4 days, the audit goes away. If you don't, then they know they've got you and they just dig in and go for that, because they would rather eliminate your real estate professional status than challenge a cost seg study, because they got a better chance of overturning your real estate professional status and getting all of your previous losses revoked. So what do they expect from a good cost seg study? Good qualifications by professional. In other words, it's going to be done by an engineer, CPA, building contractor, or tax professional. Good framework means you have the same audit technique you've lined out. You document all the land improvements, personal property, and your allocations according to your HUD statements. You need a good report and on-site visits. And just a note here, most of your DIY studies that you do for $199 to $500, you input most of that data yourself, and they will only do a visit after you've been chosen for an audit. These are the 13 elements out of that IRS documentation I pulled out and said, this is what they're typically looking for. And it's important to know which type of allocation method you're getting, because the Supreme Court and the IRS tax code has identified 11 different combinations of cost seg report that you could actually get. And these have all been backed up by typically United States Supreme Court cases where the IRS has lost. So what I do is I typically give you a summary narrative, an executive summary on one page that shows you exactly what you're going to get, schedule of assets, direct and indirect costs, because believe it or not, a lot of people think they're doing a great study and they ignore the fact that on any personal property, you haven't identified how much the drains and water cost lines going to the property. electrical boxes as well as circuit breakers and all the wiring between those can all be written off as well. So you're typically leaving money on that. And electrical circuits typically grand total of about $625 for routing it all the way back to the panel, including the cost to install the wire and drill all the holes to get the cables routed. And you just keep going down like that. Establish engineering procedures, statements of assumptions, certificates, exhibits, and that's just the way that works. This is the big summary page, executive summary, what I normally put out. It shows you what your typical depreciation is going to be. And then mine shows you what it's going to be afterward, as well as how much in assets we've moved to shorter lives for getting this study done. So now one of the things I'm going to talk about is what is a do-it-yourself study, because I get a lot of questions on that. And I've had at least 5 people come to me with complaints that their DIY study didn't give them the results they wanted, because they thought they would get the results I would give by paying the cheaper amount. So guys, that's not the way it works. And I'll actually go through 2 of those so you can see what the differences are. The on-site visit is always recommended. The cost is slightly higher with travel because there's some places you just can't get to. Like one out in the middle of Wyoming. There's no good way to get there. It's like $2,500 to do a travel to get to there from where we are in Florida. So sometimes it just doesn't work out. Do it yourself is usually cheaper, but it leaves money on the table and then the risk of an audit visit. On the value, do-it-yourself studies usually 15 to 20% unused depreciation in the building. Results, the IRS audit typically, they're not going to actually challenge the do-it-yourself audits too much, because you're leaving most of the value to them. They're getting the tax benefit, so they're not really going to challenge it too much. Land value is a big one, which I think is pretty much underrated. What did I do? Go backwards?
Maybe.
Yeah. Land value. All the do-it-yourselfers usually use the 20% rule, or they use the assessor's valuation, which you input. And the Supreme Court has already ruled that the assessor's valuation is not acceptable if there is another method that is closer to real value. And what I typically do is do a land search and see what the properties have sold for in the immediate area, and just apply algebra to determine if your property is larger or smaller than that, and get you a better price on that. And you'll see the differences on several studies that I've done. So you get several bids and decide what you want as far as cost to benefit analysis. There is a common myth that it doesn't make sense to do single family homes below 500,000. And that really ignores the time, because I found ways to do them for down to $200,000 and even below, if they've got enough personal property that makes sense to do those studies. More than half my clients have houses less than $500,000 that I'm doing the cost segs on. When does it make sense to use the software? Property value is too small for a real cost seg. Typically, it's under 200 grand. You need it quickly due to your last minute planning. This also refers back to anybody that's a PETA. You don't plan to fail, you fail to plan. You don't have too much personal property in the property. You've got tile or hardwood floors instead of LVT, no ceiling fans or window AC units, minimal kitchen, and many landlords have no land improvements. Some even have dirt driveways, and you just walk up the path and go in the house. There's nothing there. Knock yourself out with DIY cost seg studies in those. Okay, I've got 3 comparisons here. These come from studies I've actually done. Got a single family home, and this one is in Colorado. And you can see that they would get $42,000 with the DIY, and with an engineer study, you get $90,000 at a cost of $3,500. So you have to see what's that $3,000 get you as far as additional tax savings. I've got a fourplex in Cincinnati. And this is the one the guy called me up and said, "Hey, I didn't get anywhere close to what you had because I went with a cheaper study." And this is interesting. It cost him $1,700 to get $60,000, and he could have spent four to get $167,000. And he actually did. He actually spent the money twice to get this $167,000, and I'll show you that in a minute. Now, all the East Coast, West Coast people, cost segs are more difficult to do out there because the land value is so high. But there are still substantial savings you can get just by doing land surveys to see where it's at. So I'm going to show you examples of this for all you engineers in the crowd that like to have details. So here we go. On the one in Colorado, I actually took the information and paid to have a DIY cost seg study done so I could see what the results would be. And that'll show up on the next page here. That's this property. DIY study was $640. Mine was $3,250. Same purchase price, the land value they had plugged in as $123,000. When in fact, land value was only $35,000 according to sales of lots in the area, not assessed value. And that's a big difference of almost what 20 some percent.
$100,000, yeah.
Yeah. The results were, and you look here, I didn't even take the land value off here, but it changes. Personal property went from 7% to 14, land improvements 3 to 8, and the building went up because we eliminated the non-depreciable asset of the land as much as we could. This is the California fourplex. And you can see here the difference in the land value. There are comparable sales, at least 10 parcels around that average $230,000, as opposed to the $486,000 they had by the assessed values.
It's a big boo-boo.
Yeah, yeah, and I've run these in New York, New Jersey, as well as all up and down the coast of California. Even the $1 million homes, you can get substantial discounts on the land. And that doesn't even account for the fact that this is just the savings in year one. The fact that you've got additional $200,000 to write off over 27 and a half years gives you more income that you can play with and not pay tax on. This is a Cincinnati. It's a 4-unit. It's just an old home that they've split up. But you can see $640 versus $5,000. Purchase price. I don't know why the purchase price is a little different, but I think they had incorrectly entered information off the HUD, and I corrected it. The land value here was 10%, but in actuality, in Cincinnati, there's a ton. This is downtown Cincinnati. So there's a ton of old vacant, undeveloped land that they tore the buildings down just sitting there. So the land is really much cheaper there. So you can see the difference in basis was significant with the land. Personal property went from 6% to 24%, getting a huge bump there. Land improvements, because they had retaining walls and steps, we bumped that up another 3%. And the building dropped down to 75% of what the previous allocation was.
I see a theme here, Vern. It seems like in the areas of the country where you can pick up cheap lots, there's a lot bigger benefit here.
Oh yeah, yeah. Because you can allocate less to the land and more to the building and to the other improvements. So
Erie, Indiana, folks.
And so we walked from Toledo to Colorado to California. So it's like this applies everywhere, guys. Now you've got to decide what you're willing to give up to go with a do-it-yourself cost seg study. Is it worth paying less to get less? The extra depreciation of personal property and land improvements is typically 10 to 20% over what you'd get with the DIY study. The extra depreciable basis due to overvaluing the land is between 8 and 30%. No on-site visit is not completed by a recognized professional. It's typically you sitting in front of the computer, entering all your data to get a defective study. It's not done by a CPA, engineer, building contractor, tax professional. And I got to tell you, I'm not a CPA, don't want to be one, but I am an engineer, building contractor, and tax professional. So you're getting three for the price of one right now. All right, we're doing fairly good on time. Opportunity zone. This is my favorite, and what I'm going to do is just show you what I have done with my partner in Indianapolis. We started doing 2 to 3 of these, and we are actually, and you can get these anywhere, guys. Just go to opportunity zones. Just type in opportunity zone in your state, and it'll show you a map like the one on the left. And then you can zoom in. Here's Indianapolis, and we're right about here. Not quite in the downtown, but 2 miles from the Lucas Oil Stadium where the Colts play. We've got, well, I'll just show you, not get ahead of myself. We started with this nice little home. It was abandoned. And so we cleared the lot. You can see that here in this page. We poured the foundations and started building our house. You can see we're framing it here. These are pretty much starting to work on the inside. Here's it all completed. And this is what it looks like when we're done. And we are leasing these to medical professionals in their last 2 years of residency. Typically, there's 4 doctors in training staying at these houses for 2 years. And each of these houses, I think they're around between 2,500 and 3,000 square foot per side. And they rent for about 3,600 per side. Just to give you some idea on what these are, not simple properties. We build these for about 670 to 770, and they appraise when done for 1.1. So this is what the cost is. Land cost is about 100 grand. Construction 600,000, because these were the first ones we built back in 2019. Total basis is 700, 1.1 when we're done. And all I've done is I'm taking cost segs out of the mix here. This is just buying and holding for 10, 20, and 30 years to show you the difference in what it would mean. If you just did standard depreciation, you're going to get 22,000 a year on savings. All you engineers out there, this is what the depreciation schedule looks like. And no, it doesn't add up to 600,000 because I wasn't going to try and put in the 0.5% to get you. It's close enough, guys. This is what it looks like, and this is where I get all the facts and figures, and I actually pulled the gain off of the tax table and calculated that by hand myself to make sure it was right. Got the total depreciation taken. If you sold this property after 10 years, you'd net $269,000 in taxes that you didn't have to pay. That's not cost seg, net operating losses. That's actual cash money you would have to pay the government if you didn't do opportunity zones. So what I've done is I put a table together to show after 10 years, you're gonna save 269. After 20 years, 512. And after 30 years, you're going to pocket $805,000 in tax savings, because you can decide when you want to sell, either 10 years, 20 years, 30 years, or anytime in between after 10, and step your basis up to the fair market value and not recapture any depreciation. That's a big one here. It's like a double bonus.
Huge.
So, and if you happen to do a cost seg, guess what you can do? You can pay your capital gains tax with net operating losses from these properties. And since the only money we put into these deals to get going was our original capital gains, which amounted to about 20% of the total cost. So the rest of this is all money that we borrowed from the local credit union to build these. And so you got to ask yourself, what does it mean to be an opportunity zone? Well, think about this. In 30 years, we don't plan on selling. Our kids might when we're done, because I'd be, let's see, 25 years, I'll be 115. So hopefully I'm still kicking. I plan on it. But we started to do 2 or 3 of these, okay? We now have 23 in process. So yeah, it's about a $16 million cost savings that we can see right now. That's what opportunity zones can do for you. This just gives you some idea what you can do in an opportunity zone, because we real estate investors tend to think all you can do is real estate, but we're missing the big picture here. If you started a business and moved it into an opportunity zone, all of that will also qualify. So you could build up that business and sell it in 10 years and take, you wouldn't have to pay tax on any of that gain. This is just what people are doing out there today. So just to give you some idea on all the different things you might be able to do with an opportunity zone. Now, this is one of the things Ash will be talking about next month. And I'm not really affiliated with Ashley. I'm a paying member of his group. Every Tuesday we get together from 10 to 11:30 and go over what's going on with opportunity zones. What's all the paperwork you got to do? How do you get in? What qualifies as contributions? When can you contribute? And make sure all of the T's are crossed, I's are dotted to make sure we stay in compliance, because they have just added with this new bill in Opportunity Zone 2.0 penalties. That if you don't fill out the paperwork right, you can have a $500 day fine up to $10,000. Or if your fund is greater than 10 million, it can be $50,000 just for putting the information wrong on a piece of paper. So, what we've got right now is anything purchased in an opportunity zone that currently exists, you can still get the 40%. But if you had bought it in 2025, you can step up to a bonus depreciation. So there's ways now actually to buy in right now. You don't get the capital gain deferral of 10 or 15% like they did initially back in 17 or 18. But that was never really the hook for me and my partner anyway. It was the big, beautiful back end, as John Heyer likes to say. It's a J-Lo back end, okay? That's really what we're going after, because that can be a great retirement planning strategy.
Yes.
You can still contribute your capital up till December 31st of 26, but you got to have your project finished by 2028. And there's still some discussion. You might be able to push it out a little later than that. So that's pretty much what the opportunity zone currently is. And they're calling it 1.0 right now in the bill. Opportunity zone 2.0. All opportunity zones are made permanent. They're not going away. Every 10 years, when the census
She
is
in there?
done,
What he said? Ask her what he said.
Hey, Brett, can we say what happened to you?
Oh, can you
Yes.
guys
Okay.
mute? Amelia, can you mute them?
every 10 years, when the census comes out, they're going to reestablish new opportunity zones, and this whole thing will keep going over and over again. For Opportunity Zone 2.0, the governors decide those zones sometime between July of 26 and January of 27. And you can contribute your capital gains starting in 2027. So you don't have to wait until 27. You can still get involved in the Opportunity Zone 1.0. And those maps are out there now. You can just log in and see where they are. Again,
Hey, there is a question, Vern, on that. What is the best website to find the opportunity zones?
It's opportunity zones, and then your state. Every state will have that. There's like 3,300 different zones in all the states.
So opportunity zone or zones, plural?
I don't know. Type it in both. Google will figure it out. I don't keep all that useless information in my head. I can go anywhere on the internet and grab it.
Well, you will learn that, guys, on next month's call with Ashley. I'll tell you that. He does have he has that dialed in.
All right. And I will leave this up here. This is the end of my presentation, but Tom wanted to make sure you guys had my contact information. And I am out of Winter Haven, Florida right now. I'm in Michigan. I was born and raised in Michigan my entire life, but I moved into Florida, the no tax state, once Michigan decided to start taxing my pension the year I retired. So it's like I did all my planning on one area, and they decided to mix the whole thing up. So I said, screw that, I'm gone. So, okay, we can open it up for any questions. That's right at the top of the hour.
Yes, I've got some questions. So you talked about the deal you're working on with John in Indianapolis. And you said all the money you have in that whole deal is the original 20% you put on your first building. Is that correct?
Yeah, well, we've contributed multiple times as we decided we wanted to do more. And so we have now put in, I think, $1.2 million total in those funds, and we borrowed all the rest.
Between the collective of a couple of you guys, though, right?
There's just two of us, yes.
Oh, I got you. So just you and him. So because I guess my question is, because I think the first thing people that need to understand when it comes to opportunity zones is that the money that goes in there has to be, the best way for me to put it is 1031 type money. Like it has to be from a positive capital gain from another, thing that you sold, correct?
It's got to be a capital gain. Doesn't have to be 1031.
Okay.
Typically, you guys are all real estate investors. Sell a property you've already depreciated. Take the money and roll it in because you're going to have a low basis anyway. You might as well take it, defer it, and put it to use. That's what we've
Right.
done.
So I just want to make sure people understand that in order to get into that game, it's got to be a capital gain in order to get into this whole world.
It's got to be some gain. Stock sale, bond sale, sell a car, sell a mobile home, sell a motorcycle.
So that's the first piece, and then the second piece, and that's kind of what got me stuck the whole first time that this came around. I'm like, I don't really want to sell anything right now that's going to present a gain that I don't already want to take advantage of that gain or loss at some point. But so in order to get into the opportunity zone, that's how you have to start. Now, I want for the opportunity zones, you can borrow money, which you just heard Vern talk about. They only put 20% of their own money into that first deal. So that's one thing I know. Now the next question I have for you, Vern, though, is can you continue to refinance and then just do another deal with the proceeds of the money that you just got out of the refinance and continue to keep that new next? So like in your example, you started with one of these duplexes, and then I'm assuming you refinanced with the bank, had cash, did a cash out refi, and then did another one. Is that how you guys have done this?
No,
Okay.
we have not done any cash out refis because with the cash out refi, the rules are clear. You have to have that money sit in the fund for 2 years before you distribute it. So what we have done is we have borrowed. We've actually got a local community credit union. We've actually maxed out. We are now their single largest client. We're limited in what we can borrow from them. I think we've got 18 million that we're able to borrow, and after that, we're tapped out. They can't go any higher because of banking regulations. So we are not refinancing. When have I lost it? What's going on?
Yeah, I don't know. I think you lost something there, but
Elon Musk has got
there we
something
go.
going on with his satellites.
Yeah. Well, you froze for a second and your screen froze. So
Where did I stop talking?
no, we heard everything.
Oh, okay. All right. So what we've been doing is we have not been refinancing. We are going to, because when we started this, we were getting construction loans for about 8% and roll over into perm financing for 3.9%. And then Biden and his crew announced that Build Back Better, and hidden in the bill was the fact that steel and concrete prices would go up 35%. And so we jumped right ahead and put 6 holes in the ground to get ahead of that. But what we didn't realize is that also allowed us to make sure we get financing locked in at those low rates. And we refinanced all 15 of our properties for around 4.9% for 15 years. So we were pretty much locked in at these rates. And we are actually looking, we might be selling a property to be able to take the income and pay down some of the mortgages because it 8 or 9%, these properties don't make sense. So we have to knock down our LTV to 65% or 50% to make the properties cash flow. So
I guess my question is, could you refinance and then invest that same money back into another project in the opportunity zone? Or do you have to continue to put new capital gain money in order to do another project?
no, if you sell a property within your opportunity zone, you can, or refinance, you can use that money. You just have to send it back up to the QOF, your fund, and bring it back down to a new QOZB, which is what Ashley refers to as a qualified opportunity fund or qualified opportunity business. Now,
I got you. Okay.
in our case, a lot of people starting out, they just have one fund and then they fund one QOZB, which they build all their houses. at $1 million a pop, we don't want to have all that hanging out there. So we've got 23 different QOZBs that we have to do a tax return on each year to kind of flow up because we want to limit our losses if something happens, you know.
Interesting. Okay. Um, there is a question from Kevin. Capital gains from sale, do you need to use a third party to put into opportunity zone or can you touch the cash?
This is not like a 1031. It's not like an IRA. There are no prohibited transactions. You can actually loan money. If you know you've got capital gain coming up, you can loan the money in this year, put your capital gains in next year, and that will qualify as capital gain contribution when you just pay it back out to yourself. So,
The only thing it's my understanding you cannot do is buy a property from yourself.
you cannot. That is true. But you can lease it from yourself.
Yeah.
6 of those properties we had already had because we were building, he was building in this opportunity zone, didn't even know it. And I said, you know, we thought we couldn't do anything with those, but we found out in later subsequent revisions to the bill, you can lease property from another of your LLCs. And we just pay a land lease every year, $3,000 to build this property. As long as the bank is okay with you having a leased lot with building, but you're two tied together, they're okay with lending money on that.
God,
So we've done it on 6 properties so far.
Is there any other questions I'm missing here? Nathan, I'm assuming you're referring to 1030. Okay, I think he was talking to Kevin. So somebody did talk about sharks in here, and I did want to address that. When you're dealing, what Vern is talking about, everybody, and correct me if I'm wrong, Vern, but I believe what you're talking about is having your own opportunity zone. Nothing that Vern has talked about today has talked about investing in somebody else's opportunity zone fund. There are those opportunity zone funds, and Ashley is going to get into that next month. I'm sure he's going to talk about the difference between having a big fund versus what you're talking about when it's just you or you and a partner. Um, but I will. There's somebody certified lending. I'm not sure exactly who that is, but there are sharks that are in this realm, and a lot of the deals that I have been pitched from other opportunity zoned funds are garbage. So don't use this as a shiny object to just like go look for opportunity zones to invest in. Vern, I'm sure that you're smiling because you're seeing this just like I am. A lot
I'm
of the
smiling because
deals.
I know who that shark is.
Well, I'm just saying, I know there's more than one. I've seen lots of garbage deals that are never going to work out for those investors because they're only chasing this tax benefit and they're not looking at the deal to make sure that it's actually a good question.
Most of the funds that were starting out, like Kathy Fetke on the West Coast, was looking into opportunity zone funds, but they're not interested in holding for 10 years for tax benefits. They want to buy it, get in, get out, and make their money. And I'm not disparaging that, but this is not set up for that. All of the opportunity zone funds that are in Ashley's circle are typically the mom and pop. They're 2 guys come together. They set up their fund. They go manage it. We're not looking for people to invest in funds. We don't want that because it's a pain in the ass dealing with people. Okay, it's that simple. I can deal with 1 or 2 buddies. That's about all I want to do. Where else was I going with this?
Well, I guess I'm less talking about investors. So if you're an investor and you're sitting on cash, I would be I wouldn't say leery, but you really do need to make sure that whatever you're going to be investing in with that cash and somebody else is going to be like the general partner and maybe you're a limited partner in this type of deal, that it has to be a good deal and it has to be something that you would do if it was outside of the opportunity zone. Don't do it just because it's in the opportunity zone. I cannot stress that enough. Yes, Sri, I think you were asking if you can ask live questions. This is the time, guys. If anybody else has a live question they want to ask, if you guys just want to unmute and ask those questions, I think Vern, you're okay for a couple more minutes here.
Oh yeah, no problem.
Okay.
And
Hi,
I will
Vern.
say this, in the Tuesday meetings, I'm with Ashley. I would say 75% of the fun people that came in are no longer there because after 6 years, they got washed out because zoning, compliance, they couldn't get funding for the deal because interest rates went way up. It doesn't make sense anymore. So it's really just the people that are left doing the small jobs like certified investors. I know what he's doing.
You got it. All right, Sri.
Hi, Vern. Thanks, Tom. Good to hear you speak at John's event a couple of weeks back in Atlanta. We have an opportunity. So we are basically a note buyer. We buy real estate too. So we have an opportunity where we are buying a new construction gone bad. So two of the lots are in DC and four lots are in Maryland. Maryland are vacant. They don't have any construction on it. So my plan is to buy the note, which will encumber all these four parcels. The DC lots, one of the property is about 80% complete. So at the end of the day, uh, the DC lots are not in opportunity zone, but the Maryland vacant lots are in opportunity zone. So my plan is I don't know how to structure this. And I requested to join Ashley's right after I got back on October 8th. I haven't heard back from them. So if you can help me out to get in touch so that I can join the group, that'll be great. So my question is,
Send me your contact info to just text it to me.
okay, I'll do that.
Forward that to Ashley because
Yep.
it shouldn't take that long.
Yep.
But
So-
that is a question asking because you've got contiguous parcels, and I didn't mention it here, but part of the opportunity zone is you have to contribute at least 100% of the improvements to the property to qualify as qualifying property. In other words, if you bought a building that's 80% completed, I doubt that's going to qualify because you can't build. But anything new, you could actually do. All the vacant land, you could do that with.
Yes. So the DC properties are not in opportunity zone. We are not going to claim, but the Maryland vacant lots, it's a NAC. Basically, you need to have shopping on the bottom and residential on the top, mixed use. That's what it is zoned for. So our plan is the total payoff on the loan is much higher than what the property value is. Obviously, we are paying much lesser than what the balance is level on the payoff. So our plan is to buy the property, foreclose, and at auction we'll get all those 6 parcels back, complete the DC construction, and by that time we'll be net zero in the sense we'll zero out of pocket for the 4 Maryland lots, and that's where we're going to build, which are an opportunity zone. What I don't know is how to structure all this. Like, I buy the note in my LLC, and at the auction, can I set up a new LLC because it's going to be me and other partner who's the builder that will be building this in the vacant lot in Maryland. So, because you said capital gains from our note sales will be funding this deal. 20% and 80% will be through bank financing for new construction. So I don't know what entity needs to be in place before this all can be done, because
That's an Ashley question because I'm not even sure note gains will qualify for capital gain treatment.
Really,
Yeah.
because you said you could sell a car, you could sell a business, what have you. How is it this different?
Didn't say anything about notes. Notes are qualified as interest, so that's an
Okay.
Ashley one. He can tell you because he does this all the time. But
Okay,
I don't even play an attorney on TV. I'm just I play an engineer. Okay.
got it.
But
Okay.
that's definitely an Ashley question. Those are kind of things we do all the time in these Tuesday meetings.
Okay, I'll send you a text. Thank you.
All right, thank you.
One more question, Tom Nardone, and then I do got to step out, guys. It's quarter after now, but Tom, I think you got your hands up.
Yeah, thank you, Tom. Vern, I wanted to ask you, since you're in Florida, I bought a property in the Opportunity Zone in Marathon Key about 2.5 years ago. We immediately applied for our building permits, and we just got them approved. It took 2.5 years.
Yep.
But that puts us into another waiting list, which is the B-Pass system, which currently takes 10 years before they allow you to start your build. So, have you been in that situation? And what does the IRS say about that? Because I know there's other parameters where they want you to start your build, but it's controlled by the federal government. So, why would they put an opportunity zone in an area that takes, 12 years to build if they wouldn't allow you to do it?
I can't get in the minds of the governors there. They're the ones that set the opportunity zones.
That's a dark place.
Yeah, and this question has been brought up before. I don't know if you were in Ashley's group, but someone was actually building down in Key West and they ran the same thing. And
Mhm.
Ashley's recommendation there was sell it and move on because you're not gonna get anywhere and you just get headaches going down that road, especially with federal, you're dealing with the highway transportation there, getting evacuation routes established and getting enough people there. So um, find another one, you know.
And then- Okay, gotcha. Well, Marathon, the good part about Marathon is they allow vacation rentals up to 1 week. A lot of the other keys don't, but Marathon does. So,
Well, I would
um,
keep that in your short-term rental if you want to, then, you know.
yeah.
I wouldn't try to put it in an opportunity zone because now you're just putting you can get the same benefit doing the short-term rentals outside of the opportunity zone. So
Hmm. Okay.
All right. Thank you, Vern. I really appreciate you sharing with our community this month. I apologize for some reason my screen is not working. I'm trying to share my screen to go back to the slides that talks about next month with Ashley. So this month and next month kind of do work together. And the reason why I wanted to explain this to you guys, somebody asked me, "Hey, what's my play?" Um, Vern kind of skipped over this, and unless you were looking for it, you probably didn't really notice it. And I don't really have time for Vern to re-explain it, but just think about this. When you invest your money into an opportunity, this is the layman's terms, okay? I cannot tell you I understand this to the extent that Vern or Ashley do, but in layman's term, this is what I'm understanding, and this is why I'm so excited about this. The money that I'm going to be selling a property at about $200,000 gain, and I'm going to be selling a property right now, and I'm going to be putting this into an opportunity zone. I'm probably either going to do new construction or something that needs significant, rehab. That capital gain at some point in the future, and I'm not going to give you the exact rules, but at some point in the future, I still owe tax on that capital gain. Okay? That doesn't go away. I want you guys to make sure you understand that. But where Vern comes into this picture, and this is why this makes this so, so sweet, is if I do a cost segregation on that property in the opportunity zone, guys, you guys have to understand you are really messing with the numbers. That's all you're doing is you're moving your balance sheet around when you're messing with these numbers. So by messing with the numbers, come cost segregation time, I can use the losses from the cost segregation to pay the tax I would have owed on this $200,000 gain. So if you guys ask me, why are you so excited about this, Tom? That's why I'm so excited about this. Because then I have to hold for a minimum of 10 years. And the first time I heard this, Vern, was at John Hyer's recent event. It's the 10 years is not the big gain, guys. Think about you can hold this up to 30 years. So everybody's focusing on 10 years. I got to hold for a minimum of 10 years, but you can hold up to 30 years and then sell tax free, guys. This is to me that I don't see it's anything else in the tax code that I think is bigger a bigger benefit to what we do as real estate investors of buying and holding, real estate properties. And he gave you a bunch of other ideas today. So thank you again, Vern, for sharing with our community. I'm looking forward to spending some more time with you here in the future. And I told Ashley I'm going to probably join his calls in November. I'm just tied up almost every single week until then. So I'm excited about jumping on with that. I don't have the exact date. I apologize, guys, but it will be an hour later because Ashley couldn't get on until an hour later. So the next call is going to be 12 Eastern, 11 Central with Ashley. I'm excited about that call. Hope to see you guys on that. Um, if I don't see you guys between now and then, some of you guys I think I will be seeing at the Dealmaker in Dallas. So I'm excited to see you guys in a couple weeks. But if I don't see you between now and then, God bless. Hope you guys have a good day. And again, thank you, Vern, for investing in our community. I got to go, guys. I have to go to a quarterly meeting with my property management company. But I appreciate everybody. Have a good day.
thank you.